2025 was essentially a big year for module deployments worldwide. Now, whenever we see movement happening within polysilicon, costs will move throughout 2026. It's really driven by the adoption of copper as, or substituting silver with copper. Now, for Europe, and since this is set to be come April, procurement is going to slow down significantly, and price.
Hello everyone, and warm welcome to Sinovoltaics exclusive webinar. My name is Rasaya. I'm Media Manager at Sinovoltaics, and today I will be moderating this timely webinar on China's solar export tax rebate removal. We have witnessed PV module prices rising again, and this time it's not a short-term blip. After hitting record lows earlier in the cycle, prices started moving up in late 2025. As we enter 2026, that increase is gaining speed. Production cuts, higher input costs, recovering global demand, and major policy changes in China are all pushing prices higher. One development stands out in recent headlines. It's China's removal of export tax rebates for solar products as of 1st of April. And this is not just a policy tweak. It's a crucial structural shift. Costs that were previously absorbed within China's manufacturing system are now being passed down the supply chain. As a result, global pricing, procurement strategies, and project economics are changing. So today, we'll try to cut through the noise to explain what's really driving PV module prices up. We'll break down the true cost structure of Chinese PV manufacturing, explain how export tax changes affect margins and supplier behavior, and show what this means for module availability and project viability worldwide. Now, before I introduce our guest speaker, a few quick notes. So this webinar will last for about 1 hour, and expert presentation will be followed by a Q&A session. On the right-hand side of your screen, you can see a Q&A chat box, so please use this Q&A chat box to submit your questions at any time during the presentation. At the end of the webinar, I will address these questions to the speaker. Please also note that this webinar is being recorded and will be uploaded on Sinovoltaics' YouTube channel. If you want to stay informed about the latest renewable energy developments, please don't forget to subscribe to our YouTube channel. So now, let me introduce the star of today's webinar. So we are delighted to welcome Marius Moerdal-Bake today in this webinar. Marius, are you with us?
Yes, I am.
Hi, Marius. Good to see you.
Oh, thank you for having me.
Marius is Vice President and Head of Solar and Storage Research at Rebate Energy. And his work spans manufacturing trends, supply chain dynamics, and technology competitiveness across the clean energy value chain. At Rebate Energy, Marius oversees a research team focused on solar and storage deployment forecasts, global manufacturing capacity, supply-demand modeling, and industrial policy impacts. A couple of words about myself, as I'll be moderating this session today. In almost 10 years of professional experience, I have worn many hats, and most of them were communication hats in various international companies, starting with consumer electronics, medical devices, then insurance, and now renewable energy. For almost 4 years, I lived in the heart of Europe, Brussels, and returned to my homeland, Lithuania, to continue my professional path. And at Sinovoltaics, I run this exclusive webinar program and also look after PR initiatives. So now, before I hand over the virtual microphone to you, Marius, let me briefly introduce Sinovoltaics to those who are joining our webinar program for the first time. So Sinovoltaics is a global technical advisory firm specializing in solar and energy storage projects. We help developers, investors, and manufacturers reduce technical risks through due diligence, quality assurance, and safety assessment. We make renewable energy projects safer, more reliable, and bankable. So now I invite Marius to start his presentation. And again, please submit your questions in the chat box. So Marius, go ahead.
Yes. No, perfect. So we're talking a bit about PV pricing and trends in this presentation. We're essentially dividing it into two parts. We're looking at the silicon-driven cost increases and how that affects modules. And then we're also looking at what's happening outside of silicon. And silver is essentially the main mover that we have seen for the last 6 months. But before we go there, I think it's important also to speak a bit about demand and demand for Chinese modules. So 2025 was essentially a big year for module deployments worldwide, also for demand for Chinese modules. Now, we are expecting a dip in annual installations in 2026, largely driven by a decline in the Chinese domestic market. At the same time, you're seeing slowdowns in, let's say, more saturated and mature markets, such as the European ones, also Australia. And all of these have been historically where Chinese modules have gone right. So despite let's say, continued growth after 2026, really driven by the Middle East, Africa, Southeast Asia is also increasing annual installations, as well as South Asia. Access to these markets is not necessarily a given for Chinese module manufacturers, with Turkey being one market that you see sort of decline access for Chinese module manufacturers. India is another one, and the US, which is not really slowing down due to a lot of the similar market dynamics as witnessed in Europe, Australia, and also the domestic Chinese market. There's no real access there and hasn't been for years. So demand for Chinese modules, even if we say that the global demand is increasing for installations, it's not necessarily set to increase. So that is an important backdrop before moving into the other parts of the presentation. We'll start with the silicon-driven ones, and there's a lot that's been happening with polysilicon ever since this supply crunch of 2022, leading into 2023, and really elevated prices for polysilicon. That, of course, translated through the entire supply chain, through the wafers, the cells, and the modules. Now, whenever we see movement happening within polysilicon, there's always a delay before something happens with modules. And this really rapid decline of 2023 for polysilicon, it took some time before modules also hit their price floor. As we saw modules hitting this price floor, you also start to see, annual statements coming out from these manufacturers, and they're essentially losing money off of producing. And so you start to see attempts of industry self-regulation, be it setting benchmark production costs in October 2024, and you see the development of these industry self-regulation alliances, but there's not a lot of movement happening despite all of these efforts for quite some time. The only real increase that we saw from 2024 into 2025 was this installation rush ahead of the new market policy for renewables in China, where you saw roughly 75% or so of annual installations in 2025 being deployed ahead of June 1st. So that, of course, drove procurement activities, and people were able to increase the prices for their modules. But after this initial demand spike and then the drop, module prices kept declining. And we have seen sort of a similar thing on polysilicon, but then we see the anti-involution campaigns and this price law amendment of July 2025, which did lead to an increase in polysilicon pricing, but it's very limited what's been able to be passed through to the modules just because of the current market dynamics with oversupply. We are starting to see an increase in the Chinese domestic market with the silver price pass-through. I mean, cost is definitely increasing, not only from the polysilicon prices going up, but also silver going vertical, increasing the cost of cells. So there's this new cost floor now in the market that manufacturers are trying to hike prices to meet. And it's also being helped by the export tax rebate removal, of course, driving overseas demand. But moving a bit into polysilicon, because something also happened in January of this year with antitrust concerns regarding the self-regulation efforts. So while let's say the gross profit margins really saw an improvement after the anti-involution campaign, you're now seeing that the future prices for polysilicon after the joint venture enterprise was essentially being stopped in its tracks, and people are a bit worried about the consolidation of polysilicon capacities. So as you can see, polysilicon manufacturers, they are still making a profit at current price levels, meaning that there is some room to move with the following downward pressure on polysilicon prices that essentially happened when these antitrust concerns were being presented and the joint venture stopped. So how has this really been affecting the inventory and the production of polysilicon manufacturers? Well, if you look at sort of July 2025 here, production started increasing quite a lot. Production started increasing roughly at the same time as inventory started dropping, as downstream manufacturers were, more or less hoarding polysilicon in anticipation of prices increasing due to the anti-involution policy. And as you see that you are suddenly making a profit off of your polysilicon production, the natural response for most manufacturers is to increase production. But we haven't seen increased transaction volumes of polysilicon happening, and so inventory has actually been accumulating ever since the prices started to increase. And now we are seeing production starting to taper off amongst these polysilicon manufacturers. Tongwei, the largest polysilicon manufacturer globally, have also stated that they are intending to hold production until May of 2026 in an attempt to stabilize prices. But there's definite downward pressure on polysilicon prices, which could aid the cost of modules from the Chinese manufacturers down the line. So that was the polysilicon. Now, as we have seen that polysilicon increased prices haven't really translated through to the increased module prices, at least not from July. Silver is another story, also because the effect that the cost increase for silver has had is way larger than that of silicon-based costs. And silver has actually been in an undersupply globally since 2021. There's also this issue with silver that for the mine supply, as you can see as the bottom bar here of this chart, only about 20, somewhere north of 20% of these mines are dedicated silver mines, meaning that if we do see demand spike for silver, the flexibility of silver supply is not necessarily there to meet a surge in demand. And so prices can be quite volatile. This old other supply is really recycling and scrap, whereas the rest of the mine supply would be, silver being a secondary or byproduct of, be it zinc or copper or other forms of mining, which of course follows the demand for their primary markets. So this undersupply and spike in demand has really seen silver prices move vertically over the latter half of 2025. And of course, this translates through to increased silver-paste prices, which doesn't really seem to be stopping anytime soon. And in January, silver-paste prices for a full-fledged module is now roughly 24-25% of the current cost picture. So any movement within silver will greatly affect the cost of a finished module. If you look at cell level, silver paste is now roughly half the cost of a finished solar cell. So this will be the big mover as to where the cost of modules will be moving. So if you look at the picture for, let's say, costs and gross profit margins for cells, it's a bit different than for polysilicon, where we see that polysilicon manufacturers have seen increased profits after July because their costs have more or less stayed the same, but prices have gone up. As cell prices have gone up, it's also followed by a big increase in costs, meaning that these cell manufacturers are not necessarily making any money, even if price quotes and actual transaction prices for solar cells have increased. And so prices are not really expected to turn downwards again, because there has to be now upwards price pressure, just given that these manufacturers are still producing at a loss at current price levels, with silver prices being the really big mover for their profits margins. And as we can see that when the silver paste prices really started accelerating in October of 2025, the increased production costs also drives down the actual production levels of cell manufacturers. If we were to extend this line a bit into January and change it to weekly, you will actually see that inventory also started dropping. And this is really because suddenly you see a surge in overseas demand for Chinese modules prior to the removal of the export tax rebates. And so module manufacturers, they're hiking their price quotes. Actual transaction prices are way above, let's say, mid-2025 levels. And as such, you actually see transaction volumes happening. So there is support for the increased cell cost and the increased cell prices. There's also now support in the market driven by the surge in demand for hiked module prices. The real driver, let's say, as we move further into 2026, will be where is the cost settling? Because silver prices are not necessarily set to extend this upward momentum all throughout 2026. And while I'm not the silver analyst or expert on silver prices, a lot of people seem to think that it's definitely overpriced. A lot of manufacturers are moving away from silver, doing base metal substitution, moving into copper or high copper concentration pastes. So the question where these module costs will move throughout 2026 is really driven by the adoption of copper as or substituting silver with copper, and whether or not the silver price can actually stay as high as it is, or if it will drop down. Now, for Europe, and since this is set to be, let's say, a bit Europe focused when we're talking about prices moving forward, the outlook for demand is not great. The state of the market is probably going to be oversupplied of Chinese modules for quite some time. And access to this sort of flattening demand in Europe is also decreasing as you see renewable auctions within Europe, capacity of that being, let's say, dedicated towards the Net Zero Industry Act and resilience criteria. I think the latest one was one of the Forex auctions in Italy, where roughly 1 gigawatt of actual capacity demand for solar stated that you can't really use Chinese solar cells, modules, or inverters. So as demand for the market itself is dropping, you're also seeing that the portion of demand accessible to Chinese manufacturers will also continue to drop throughout 26 and 27. The export tax rebate, let's say, effect on how people have been procuring, it's definitely led to a surge in procurement activities in Europe at the beginning of this year after the, let's say, announcement of the removal. But it's also been rumored that these export tax rebates will be removed for quite some time. And just looking at the Chinese module exports going into Europe, you have seen quite a big uptick in anticipation of this already in the latter half of 2025. And so as procurement continues to surge now, moving up to the deadline of April 1st, you're very likely to move into a new market situation where procurement is slowing down quite significantly. And whether or not the acceptance of these prices will be there or not, that is more a question of the actual market dynamics and where the cost will move for the modules. So how does this actually affect the project economics of solar projects in Europe? Because as we have seen throughout 24 and 25, is that if you're planning to do a merchant solar project in, let's say, main European markets, be it Germany, France, or Spain, your profits are being deteriorated by negative hours and really depressed capture rates. We're also seeing that while the cumulative number of negative hours in European markets has been increasing steadily year on year, it's really when they're occurring that's, let's say, of consequence to solar PV projects, with most of the acceleration happening on these negative hours during the summer months when solar is actually producing. You can also see this in a couple of markets as to when it happens during the day. And it's not as if the European power system is purely isolated from country to country. It's actually heavily interconnected. And so as you keep installing a lot of solar in Germany, that is also going to affect the capture prices for your solar projects, be it in Sweden, Denmark, Norway, or otherwhere on the continent. It's not as if all markets are equal in Europe, even being interconnected. And while the trend is very similar for all of these markets, you do see a few of them being a bit more resilient towards the cannibalization of these capture rates. Now, Italy is one of them, where it's a big market for solar PV installations. It's being supported by auctions. And we've only seen a drop over the period of the second quarter to the third quarter from 24 to 25, from 85% average capture rate during that period of time down to 81%. Now, if you look at markets like Germany, it's been a drop from 56% to 46%. Spain during that period in 2025 was down to 42% of capture rates, meaning that you're only receiving 42% of the received price in the market for your solar generation. And if you're now merchant, like, this is going to be impossible to deal with. And so for standalone solar PV projects, you're really dependent on guaranteed offtake agreements, be that a contracts for difference, be it a corporate PPA, or if you are looking to go into the merchant market, you need to do hybridization with batteries. And batteries is more or less the hope, I think, for future European solar PV growth, being able to move generation from those hours where you're seeing negative power prices in a lot of markets into the evening hours, is essentially saving a lot of the expected economies for PV projects. Just diving a bit into the details for Germany and Spain, since I already mentioned them on the capture rates. For Germany, year on year here, it's just been a downhill slope. And moving here from 21 all the way down to 2025, you actually saw a dip down to 31.5% in June of this year. Now, we did see a bit of, let's say, short-term relief in July, up to 68%, but that was really driven by demand response. You had a heat wave all across Europe, and you had limited generation from other sources. Wind was not really generating, and you saw limited responses from coal and also nuclear. But following this heat wave, and then you had the AC demand, of course, helping out as well, In August and September, it kept dropping down. Now, in Italy, the story is a bit different. You have a bit of let's say it's also a bit of a different landscape, given that Germany has been installing quite a lot of solar PV from the 2010s into the 2020s, whereas Italy more or less slowed down and has only really seen a surge in installations over the last couple of years. There's also a policy difference here with regards to power prices in the Italian market, not really allowing prices to go below zero during those hours of the day, especially during the summer when solar generation is running rampant on the grid. So what does this really mean? It doesn't mean that Europe is not really an accessible market for solar PV manufacturers, especially the Chinese ones. It's more about where do we still have room for installations and which countries do have policy support. For prices, what this means, and maybe we can dial it back a bit to the beginning of January this year, when these manufacturers in China that had really intended to stop manufacturing for the beginning of the year, as they see that demand is cooling, the price of production is increasing. They were more or less saved by the announcement of the export tax rebate, because that really led to a new surge in overseas demand for their components. And so they are producing, they are hiking their price quotes to meet, let's say, the increased cost of manufacturing. They're seeing somewhat limited acceptance in the Chinese market, but in overseas markets, people are still procuring as they expect the export tax rebate to come in, or removal to come into place. The market dynamics with supply and demand is not going to change because of the export tax rebate. Europe has been procuring for quite some time now in anticipation of this change. What it really does is that it sets a new cost level of manufacturing. So as they're now hiking prices, let's say up towards the quotes in late January are somewhere north of $12 per watt peak for DDP modules moving into Europe. That is probably where we're going to be moving as we come towards the 1st of April. As the removal actually happens, that will essentially move costs 9% up for these manufacturers. And so another price hike is then expected to happen. And it will probably be somewhere north of $12 per watt peak. But the question is, can they actually keep it there? And I think the answer to that is looking back at what's happened previously, whenever people try to hike prices because of something happening in the market, but the real market fundamentals, they don't change, is that prices keep moving back down to the cost levels. And so prices in the European market come later into this year is really going to be set by the cost level of Chinese manufacturers. It's going to be set by where solar prices are moving. It's going to be set by where are these polysilicon prices moving. Are they going to keep dropping as we are seeing or expecting from the polysilicon futures? But there will be a new cost floor for these manufacturers, and that's really where prices are going to move. So what are people doing about this, right? People have been procuring for quite some time. They're procuring now in anticipation. Transaction prices roughly around $11 per watt peak and moving upwards. But come April, procurement is going to slow down significantly, and prices are likely going to drop after an initial hike. So that's more or less our take on what's going to happen in the European market. And I think we have quite a lot of questions coming in, so maybe we'll move to the Q&A section.
Thank you, Marius. Thanks a lot for giving this outlook of what is driving the prices of PV modules these days, and what we're gonna see happening in terms of PV prices in 2026. We do have plenty of questions in the Q&A chat, so let me just get straight into them. So a question from Vikas. Do you expect any adverse impact on solar cell capacity additions in India due to surge in silver prices? That's the first part of the question.
Well, I mean, the cell capacity additions in India, they have to happen. It's just based on the protective policy nature in India with these approved lists, right? You have the ALMM1 for modules, the second one for cells. And what you have seen in the Indian market is, I would say, incredible acceptance for elevated cost levels or price levels for modules that do fit these domestic content requirement targets. So there's a big, and this is really a trend that happens in, let's say, more restricted markets when it comes to imports, especially of Chinese components. You've seen it in the US, right, where the prices for something that's domestically manufactured is vastly different from whatever's being procured from Southeast Asian manufacturers. And as you increase the amount of domestic content coming in, and you receive some kind of benefit or incentive from the government, these price levels, they diverge more and more. And in India, it's no real different when it comes to this, where if you're now buying a Chinese cell and you're assembling it into a module in India, I mean, you're selling it probably on the market for 15 to 16 US dollar cents per watt peak. But if you now have a Indian cell and assembling that into a module in India, like the market will accept upwards to 30 US dollar cents per watt peak for that module. And so the real imbalance between cell manufacturing capacity and module manufacturing capacity in India and the amount of demand that they can access when they're selling in the domestic market, it's not going to necessarily, let's say, it's not going to negatively impact the capacity additions for Indian solar cell manufacturing, but it will increase prices for, let's say, DCR approved modules for Indian projects. And I believe actually that Indian manufacturers have stated, at least leading ones, price increases or price hikes of 25% already in January, just because of the increase in silver prices.
Okay, and what impact do you see of this latest EU and India free trade agreement on solar PV industry in India on a long-term basis?
Yes. I mean, long term, it could be good, as we do see, let's say that, I mean, you have a lot of capacity set to come online in India, right? And let's say installations, that's also been growing quite rapidly, but you have more manufacturing capacity coming online. You're possibly losing access to the US market, which has been another prime destination for Indian solar cells and modules over the course of 24 and 25. Now you have this AD/CVD investigation into Laos, Indonesia, and India as well. And so if you have too much capacity compared to what's being installed, of course, prices are going to keep coming down. The actual manufacturing cost is not 30 US dollar cents per watt peak for Indian cell plus module. So these costs, they do have to come down. First and foremost, before we start seeing significant amounts of Indian goods coming into Europe. What they would be competing for is essentially these NCIA auctions with resilience criteria. With this latest one that I previously mentioned, the FURX one in Italy, around 1.1 gigawatts of demand, saying that you can't use a Chinese cell or module. People are probably not going to be accepting price quotes up towards 30 US dollar cents per watt peak for that. So it's more likely to be met by something manufactured in Southeast Asia or from Europe, with 3Sun, for instance, being a contender there for that demand. But prices have to come down before any sort of impact on, let's say, exports of modules and cells from India is going to make its way into Europe.
Okay, thank you. We have another question from Lara. It seems copper is going to be replaced by silver. Is that correct? And if so, do you think it will happen in the short term?
Yes, and yes. We've already seen statements from, I mean, the real majors, be it Longi or Jinko and ICO, that all of these are essentially moving their cell production lines from utilizing silver paste to either a full substitution with copper. That seems to be the case for back contact modules, or it's going to be a high concentration copper paste. More or less similar to what we have seen for heterojunction for quite some time now, where just due to the nature of the processing for heterojunction being at a lower temperature, they've been able to use silver-plated copper for quite some time. And of course, that decreases their cost picture when it comes to manufacturing. So it seems as if significant amounts of, let's call it tier 1 capacity in China is now moving from silver to copper, and it's stated to happen within 2026. So, I mean, depends on how you define short term, but we're expecting more, let's say, solar cells with copper contacts coming out of production lines in 2026 than in 2025.
And just to add on this question, Marius, have you witnessed any manufacturers sharing that this replacement will also come with some decreases in efficiency?
Well, I mean, I don't think they have stated that it's going to come with a decrease in efficiency. I think it's implied. And maybe Sinovoltaics is probably the correct company to ask about this. There's heavily, let's say, degradation increases linked with utilizing copper instead of silver, especially in humid conditions. And so that will take a toll on the efficiency over the life cycle of the module. And then copper is also a worse conductor than silver, right? So there will necessarily be efficiency losses.
Mm-hmm. Okay. Another question we have from Eva. If the procurement of solar modules is dropping starting April 2026, is it safe to assume that the prices of such modules after April 2026 will be as competitive as on average in the years before, as it will now simply have to absorb the tax?
Yes. If we go to, let's say, December 2024, you did see a reduction into these export tax rebates from 13% to 9%. Manufacturers were essentially forced to just eat that cost themselves. Is it sustainable to eat 9% on top of the increased cost of manufacturing now, with silicon prices having been elevated for a bit, with silver prices going vertical? Probably not. They will have to try to share the burden with people essentially buying their modules. Otherwise, I mean, production levels just have to come down. And so, as I stated, like, there were plans for the beginning of the year for a lot of manufacturers to not run their production lines, as they had already seen a lot of interest in procurement activities from Europe, from Southeast Asia, Africa, and the Middle East, as people were expecting these export tax rebates to come, but nothing was announced. Now, with the announcement, you suddenly saw an increase in demand, right, and acceptance, and an attempt to hike the prices just because of costs going up. But after 2026, I believe we are looking at two scenarios. We're either looking at prices dropping to just slightly above the cost of getting a module from China to Europe. That requires some regulation and discipline on the manufacturers themselves to make sure that they don't underbid each other in an attempt to offload capacity to Europe. The other scenario is that it's going to be like every other time prices have been hiked after some kind of announcement or policy change. you will see a short-term increase before it just drops and continues to drop actually below the cost levels. So, I mean, it's difficult to sit here and look with a crystal ball, but the aim of manufacturers will be to stabilize somewhere above the cost of producing. But if they're, let's say, not adhering to what's happening in the market, prices will drop back down below the costs.
Thank you, Marius. Another question. I think you slightly touched on this, but maybe the delegate of this webinar missed this part. Why silver price increased drastically within such short period of time?
Yes. Well, I mean, I'm not the silver analyst, but what I've heard is essentially a lot of silver has been moved to the US, and so it's not accessible for, I mean, Chinese module manufacturers. And so you have had this supply-demand imbalance on silver for quite some time. And suddenly you have even less supply, and prices are being hiked because you see a lot of people asking for it, but there's limited supply, right? So that seems to be the reason why it's been increasing so rapidly. When you also talk with people that actually looks into silver quite a bit, they are stating that the current levels are too high, that this is probably not the real price of silver. But you also have, of course, if you see a spike in demand and the nature of the silver supply not really being flexible to meet increased demand, that will drive these really volatile prices. So I think what people are expecting for silver prices, and also then the silver paste prices going into modules, to stabilize at some point and then probably start coming back down. But I don't want to be the one forecasting silver at this point. It's a difficult one.
Okay, thank you, Marius. Let's shift the discussion towards another very important element of renewable energy is the batteries. So a question from Laura: how is the tax rebate removal likely to impact or have a knock-on effect on the BESS market?
So for BESS, I mean, it's a bit of a different timeline. You're essentially seeing something similar to what happened to solar back in December 2024, before full removal will happen in 27. Now, let's say that the strategy of manufacturers here seem to be, we're going to try to split the cost burden with people purchasing. BESS manufacturers have not had, let's say, equally tough years since 2024 as solar module manufacturers. Now, of course, a lot of solar module manufacturers are also selling DC blocks moving into Europe. But I think there will be, let's say, more acceptance for sharing the cost burden with manufacturers on BESS than for solar modules. The market is not equally oversupplied in Europe when we're talking about BESS. And it's also something that's really, let's say, demand for BESS installations in Europe is set to keep on growing quite a bit and accelerating, whereas for solar, it's slowing down, right? So you have the similar market conditions, or let's say the same market dynamics that's really slowing down solar additions in Europe are the ones that's accelerating BESS additions. So I'm not as worried about, let's say, the profitability of BESS manufacturers as I am for module manufacturers.
All right. Question from Jacqueline. So do you believe that some manufacturers will go bankrupt due to the removal of this export tax rebate incentives?
I think we've gotten some version of this question after every policy change attempting to consolidate the Chinese PV market for years now. And I think everyone is just equally surprised on how slow this consolidation is going. I mean, manufacturers are going broke. Like that's a reality. It will probably speed it up somehow. But if we're looking at these, let's say tier 2, tier 3 manufacturers, they're not necessarily, let's say, the procurement choice when you're looking at the European market, for instance. So it will not help them. It will probably speed up the process somewhat, but I don't believe this will be sort of the nail in the coffin for them. They're already struggling. Consolidation is set to happen in China. I think this will happen regardless of the removal of tax rebate incentives or not.
Okay, thank you, Marius. Another question from Patrick. So you mentioned that yeah, the prices should not go, let's say, up, and because with the demand in Europe is not necessarily there. So why does cost matter when we are living in a world of oversupply on the entire supply chain? Shall prices not anyways go down somewhere in the second quarter of 2026?
Yes, I see that argument, and it's sort of difficult to be overly positive on the manufacturing market on Chinese modules, right? Yes, the market dynamics will inevitably be applying downward pressure on module prices for Chinese modules, anyways, in 2026. The costs matter because manufacturers have been delivering losses now for 2 years straight. And if you want, let's say, panels fresh off the production line, you will have to pay increased prices because the cost of those have increased. You could always buy from, let's say, a warehouse or something that would probably go at lower prices than anything that you're now purchasing directly from a manufacturer. You also have had quite a bit of accelerated, let's say, technology progress when it comes to PV modules over the last couple of years, right? You've seen the move from, I mean, you had aluminum back surface field into PERC, from multi to mono, and then into TOPCon, heterojunction, now back contacts. If you want, let's say, back contacts, you will have to pay more than for a TOPCon module. That's probably how it's going to be. And if that's what you want for your project, and you want to buy that fresh off the production line, the prices will go up. But then you can say, well, there's going to be different markets for, let's say, warehouse modules that will probably not go up.
Okay, another practical one from Beryl. What actions EPC developers and investors can already take before the 1st of April to mitigate this task rebate removal?
Well, I mean, let's say the obvious response is, of course, procuring ahead of it, right? And then the question is, if you're now being quoted a price that's roughly around the cost level of Chinese manufacturers with the removal of the export tax rebate included, then maybe it makes sense to wait. But of course, this depends on your project pipeline. So if you need the modules, then you should probably purchase them, because the increase here, if you're talking $2 per watt peak, like add that to the total capex intensity for a project, it's no longer that significant, right? Of course, if you have, let's say, done some economic analysis on your project and you see that, well, you're operating at sort of this break point that's being met by adding on $2 per watt peak, then probably not. But it's not going to significantly affect your IRR. So if you have something that you need modules for now, then buying now makes sense. Prices are probably going to keep going up until April. They're going to stay elevated for a bit after April, but then there will be downward pressure on these prices again, just due to the market dynamics.
Okay, Thank you, Marius. We have a comment from Rolandas about the topic in general, and I'm just going to read it out loud. So regarding the tax rebate removal, I don't see this as an obstacle at all. There have always been significant fluctuations in PV module prices, and 9% on PV module price translates to something like 2% in total project capex. Lower demand in China combined with long-lasting overcapacity could result in lower prices in the second half of the year and maybe cancel out the 9% rebate removal. Let's see. But in any case, this removal does not worry us or change our strategy at all. What do you think about this comment, Marius?
I think it's very in line with what I said. I mean, capex intensities are not going to change significantly just because of this 9% increase. I mean, if silver goes to 300 USD per ounce or something, then yes, you're talking significant increases. But no, it's this 9% export tax rebate removal is not gonna make or break project economics. The only thing it's really done is create this surge for procurement activities overseas, which has allowed manufacturers to hike their prices just because of the cost increases from silver and polysilicon. I think there was actually one question here as well, like why is silver prices now being translated so quickly as opposed to polysilicon? So one thing is really the effect polysilicon has on a watt peak basis. If you look at the consumption rate of polysilicon as in grams per watt peak, that has declined quite a lot. Also with the move from P-type to N-type, thinner wafers. I mean, if you were talking to people in 2022 and they were stating 3 grams per watt peak of polysilicon for a finished module, that was probably the benchmark of the industry then. Now people are saying 1.8 grams per watt peak. So the price increases in polysilicon has less of an effect on the finished module. That is one thing. The other thing is that it's passing through other parts of the value chain first. It has to go into the wafers, then it has to go into the cells, and then it goes into the module, whereas the silver goes directly into the cell. And so it's a sort of a shorter road to take before the price increases are felt.
All right. We also have a question from Victor. So you already, I think, mentioned that, but so you mentioned that the solar sector will decrease installations in 2026 in Europe as the Chinese cut production. What other factors do you think are most likely to defy that expectation?
Could you bring up the question?
Let me just find it. Yeah, there you go. Can you see it?
Yes, I can see it. All right, so it sounds like you think the solar sector will decrease. Yes, I mean, it's not only because the Chinese manufacturers are cutting production, it's just the project economics. It's now very similar to what we're seeing in Europe, in Australia. I mean, if you're now exposed to the merchant market, whatever solar energy that you're generating and sending onto the grid, you're not really getting paid for it. That is the main issue. You could be getting your modules for free, and if you have negative prices or zero prices, you're not making any money off of the project. So the factor that really defies the expectation for, I mean, let's say that we have a decline globally. I mean, the reason why we think there's going to be a decline globally is because of the project economics in China. You're seeing it now in the provincial sort of auctions. New auction prices for solar is now less than they were this time last year. But the growth kind of has to come. If it's not policy driven, it has to be market driven. And hybridization with batteries is sort of this least short to medium term growth driver for solar. But your solar project can become economically viable if you pair it with, let's say, a 4-hour duration battery. we actually did, and maybe I should have included a slide on this, but we did this analysis on sort of a project in Germany over 2024, where we saw that capture rates were roughly around 56% for a standalone solar project. By adding in a 4-hour battery, you could actually move the capture prices for that project up towards above 100% average for the entire year. So as, let's say that the BESS costs, they have been coming down quite a bit, as long as your CapEx for your project doesn't increase too much. You could probably make a lot of money on the merchant market with a battery as well. And then you have all of these other like routes to revenue for batteries, be it your ancillary markets or frequency control, arbitrage opportunities. But for solar in, let's say, a market like Germany now, or as you see in California, I think California is the prime example of this. Any project, or let's say 93% of the interconnection queue in California is now solar storage hybrids, with only 4% of that being standalone solar. That's kind of where we're moving. So batteries, I think, is the X factor when it comes to, let's say, define that expectation. Because we are still seeing growth in markets like India, like Southeast Asia, Africa, the Middle East, right? But it's the more mature markets that have been saturated on solar that need this aid of batteries to see continued annual installation increases.
Yeah, good. Thank you, Marius. Now a question from Pei. With slow demand, increasing silver prices, and increasing tax, is there any likelihood that the Chinese government might reconsider the decision to cut the 9% subsidies? What do you think?
Oh, well, now we should have had our Chinese analyst on the call. I don't think so. They're kind of, when they announce something, they tend to go through with it. I think this 9% removal is definitely happening.
Okay, we still have some questions in the chat box, but I'm just conscious of time. I think that the number of questions we received does highlight the importance of the topic. So I would just like to wrap up and thank you once again, Marius, for really insightful presentation. Those questions that we were not able to answer live, we will follow up via email. And thank you, the audience, for such a high level of questions received, for such an interactive discussion we've just had. And let me to wrap this up and remind you that the way we see from our client perspective, that the well-structured procurement contracts can mitigate these unexpected price increases by clearly allocating these risks rather than assuming price stability. Mechanisms such as index pricing, change in law, and tariff pass-through clauses, and transparent treatment of freight, duties, and foreign exchange exposure help convert market volatility into manageable bankable risks. So while contracts cannot prevent price increases, they can protect project economics when properly optimized, and Sinovoltaics can support developers, EPCs, and investors in reviewing and optimizing procurement contracts to strengthen cost control and risk resilience. So thank you again, everyone. We will be sharing the webinar recording with you along with the answers to questions that we were not able to address in the live webinar. And once again, Marius, thanks a lot for your time and for your contribution.
Well, thank you for having me, and thank you for all the great questions.
Thank you.
All right.
Bye.
Visit Sinovoltaics.com to learn more.